Hey guys, checking in. This is Oren. This is the game of money. I have too many brands. I wrote the book Pitch Anything. I also have a book, Flip the Script. This is the game of money webinar. I have a portfolio from Intersection Capital, and that portfolio has a big deal called OK Stone Engineering or Radical Surfaces. That is a lot to unpack, but every single one of those is essential. Once you start doing pitch at the economic level, in the deep economy, and you start moving money, these structures are necessary. But this is the game of money. Execution of the pitch, anything principles, the Oren way. Hey man, if you expect to grow $100 million, $200 million net worth over your career, move a lot of money, sell a lot of stuff, make a big impact, and you don't expect to hear any salty language, good luck. That's not how it works. You're gonna have 0 meetings with, Elon Musk, Donald Trump, me, whatever. But then whenever I use the language and people complain, I'm like, what's the benefit? You're just getting people upset. But let's roll. Inside today's playbook, the hidden effects of desperation financing, and what is 8 times bigger than the U.S. stock market. Okay, for those of you who are seeing this is a picture of my son. Took this with a camera. I'm an amateur photographer with professional gear. Don't know how to do much with lighting, but if you take a lot of photos, every once in a while, you get this incredible picture like this. And the reason I highlight this is I just wish I could go to work the way he goes to do his job, his hockey job, right? He's got head protection so he can headbutt stuff. He's got a rich sponsor who takes care of all the bills, me, and he carries around a stick, and he can fight with that stick against the other players, and that's allowed. My God, would that be amazing, right? I could storm that. We have a crypto bro fund next door. I could storm in there the way that my son Asher charges the hockey net. I'd have my full cage mask on and hide my bloodlust, and I'd be yelling at them, hey, coin boy, stop mansplaining me how the blockchain works. I get it by now. You've been doing that for 5 years. And then my hockey stick comes crashing down on the table, and I shout, they may take our lives, but they will never take our freedom. That's from Braveheart. We do a lot of movies here. Anyway, that's not happening. I wish it was. Instead, I have to sit in this pitch meeting that I'm in, my pressed khakis and my polo shirt. I have to nod thoughtfully on this fun presentation about crypto. I have to try and be polite and not use the language that you don't hear in the Bible, words you don't find in the Bible. But I'm not going to invest in this fintech crypto fund that I'm looking at. Crypto is just blending meme culture, digital tools, and opaque financial engineering to fuel a speculative cycle of manufactured wealth through leverage. And that didn't work in the railroad boom 150 years ago. It didn't work in the dot-com boom 20 years ago, 25 years ago, and it didn't work in the housing bubble 15 years ago, and it's not gonna work in crypto. You can't just manufacture wealth from debt. The real wealth in America is in the machines. The more you look at this, yes, software is cool. Yes, fintech is cool. Yes, Shopify is cool. Yes, digital music is cool. The money in America boils down to the machines that run everything. While everyone I know is obsessing over the stock market, Tesla, Facebook, Amazon, Oracle, Microsoft, all right? $62.8 trillion valuation in the US stock market. What I'm seeing, and I think you're missing, is that the real economy balance sheet has $520 trillion in assets, machinery, equipment, infrastructure, buildings, and intellectual property. That is where the real money is. So the real economy balance sheet, $520 trillion, is 8 times larger than all the US stock markets combined. That is where there's money. So whether you're building factories that are packed with $1 million machines, and by the way, that's what I'm doing. I'm building a factory in Dallas, Texas to service the US market for material science and construction, because we need a massive boom in construction. And of course, we have the tariffs that are shutting down Brazil, shutting down India, and businesses walking into my factory demanding that I sell them stuff, right? If you're doing that, as I am, or you're developing software worth millions in intellectual property, or you're launching the next Robinhood, whatever it is you're doing, there's one brutal truth, and it unites every empire builder. Everybody who wants to create something for their family, something legacy, something to pay the bills today and grow a stack of cash, for the future. Every empire builder has to face one brutal truth. You have to find lots of cash to grow that empire, or get the hell out of the empire building business. Every single titan of industry, Bezos to Buffett, started exactly where you are right now, low on cash. But the difference between them And some people, they learned how to raise capital without getting financially demolished in the process. Most founders don't figure this out. They end up like Tim Westergren, and I'm going to tell you his story below. By the way, I have a webinar on this. Click through my stuff, find a webinar by Oren called The Deep Economy, and I break all of this down, right? I'm going to show you, I show on that webinar where I recently loaded up on $30 million in one of my portfolio companies and what my next $40 million of equity pipeline looks like and where it's coming from just from now to the end of the year. So just Google Oren Deep Economy webinar, and hopefully the masters of the internet will take you to wherever I am. But for the moment, I'll give you an example of how important it is to have access to working capital. Picture this. You just built one of the most revolutionary music platforms in history of mankind. Your product has 90 million users. Your company is about to go public in a $1 billion IPO. The bell rings on the New York Stock Exchange, champagne corks pop, and you own 2.3% of your own company. And that's exactly what happened to Tim Westergren, the founder of Pandora. And it's a harsh reminder that in the world of capital, desperation for money has a price, and that price is almost higher than you think, right? It allows you to, the desperation, raising money under desperation, forces you to lose control, lose equity of your company. So this is the story quickly. Next few minutes, the founder who lost control. Tim's story reads like a founder's nightmare. In 2000, he launched what would become Pandora with $2 million in funding, right? Sounds great. Easy way to start a company, tech company, right as the dot-com bubble crashed and burst. By 2001, he'd used up all that money and he was out of cash. But instead of just packing it in, Westergren made a decision that would define his life and his health and the future of his family. He convinced 50 employees to work for 2.5 years without pay. I wrote a book called Pitch Anything. I don't even think I could run that pitch. People probably wouldn't believe in me that much. 2.5 years without pay. But behind the inspirational speeches, Tim had a really rough time, right? He maxed out 11 credit cards, accumulated over $500,000 in debt, a lot for those days to friends and family, not just random debt. And he ended up in the emergency room 3 times with chest pains. Very, very stressful to owe money, have people working for free, have your deal crashing around you, owe money to friends and family, maxed out on the surface economy, as I've been writing about, because you lose that deal, you lose everything. So he pitched the company 347 times to VC, private equity, small family offices, institutions, 347 rejections before he finally secured funding in March 2004. I'm not going to get into it, but where he got funding was some colleagues of mine in San Francisco. I don't want to get into that whole story. It's a different story. I want to focus on Tim. So the first thing he did when the money came in is he paid his employees $2 million in back salary. And it was amazing that my colleagues most of the time, they don't allow you to do back pay because they want the money to come in and build for the future, not go back and pay bills from the past. But my colleagues allowed that. So the price of desperation, the brutal math of what the desperation capital raising cost Tim Westergren is when Pandora went public in 2011, as I said before, he owned just 2.39% of the company he founded. That's not a typo, it's not a mistake, it's 2%. One of the most successful music streaming platforms in history, a huge IPO, and his founder owned less than 2.5% of the company. Compare that to Zuckerberg, Facebook, 31% ownership at the IPO. Larry Page and Sergey Brin of Google, 31% combined at the IPO. Reed Hastings of Netflix, 24% ownership at the IPO. Evan Spiegel and Robert Murphy of Snapchat, 44% at the IPO. Tim Westergren, Pandora, 2.39%, right? The medium tech founder owns 15% of the company at IPO with an average of 20%. Westergren's ownership was at the bottom 1% of all tech founders. Desperation financing. What went wrong? Well, it's the dilution death spiral. Westergren's story illustrates the critical mistakes that middle market companies make when they're desperate for capital. Number one, raising money in 911 emergency mode is extremely expensive. Nobody cuts you a break. Everybody takes everything you have. Why? Because they can. Pandora was founded, as I mentioned before, in March 2000, and probably the worst time to start a company in human history. When you're fundraising at the worst time, when everything's crashed around you, you're by definition funding from weakness. If you're a new emerging manager, new to capital raising, new to the capital markets, in a downturn, right, and you get into urgent cash needs, every dollar that you raise costs you 10 times more than it should in normal times. Raising money in 911 emergency mode is extremely expensive. Number two, 300 pitches or 347 pitches is about 295 pitches too many. VCs rejected Pandora and Tim more than 300 times before the company finally secured its investment from my colleagues. It's fair to say this is not a hot deal, and it did not get great terms, right? Nobody else wanted the deal, and the terms were, I don't want to say disgusting, but they were market. The terms were market, and Tim got crushed. The founders ended up having to give up significant, all of the company. Each round of desperation financing, raising money when you really need it, chips away at your control of the company. And it creates a vicious cycle where you have less and less negotiating power in each subsequent round. So, I've worked on quite a few companies. You would recognize their names instantly. I have NDAs on them. I'll get sued immediately if I tell you who the founder is, but I've worked on many deals. You would recognize the name of the company. You for sure have used their products in your home or on your computer. And I have seen founders get crushed by taking financing terms that they had to take at the time. Things didn't work out perfectly, didn't go bad. I worked on $100 million revenue company. The goal was to be at 250, but they hit $100 million revenue, profitable, lost the whole company, all right? So if you're leading a middle market company, the Pandora story should feel uncomfortably familiar, or at minimum, you should take a look at it. Limited access to capital markets. When banks won't lend for growth, which is where we are today, and PE are jammed up and don't fund easy deals, then that puts you in urgent growth needs that can't wait for perfect market conditions. Time pressure, right? You need money now, not later. That weakens your negotiating position. And you have limited alternatives when traditional financing, this market here today, the 2000 market, the 2008 real estate boom, the railroad boom of 50 years ago and the subsequent collapse, the tulip boom of 300 years ago, whenever that was, boom and bust. Right now we are not in a vibrant, easy funding market. Everything's tight. So the result of that is if you don't know what you're doing, you end up taking capital in terms that seem like you have to take them in the moment, but are devastating in the long run. Here's the cost of taking capital under 911 emergency situation. Number 2, loss of control. That capital is largely going to come if it's debt, with all kinds of debt service ratio coverages that the bank controls. They'll control your revenue. They can step in with a lockbox, take over the company. If you miss debt payments, or if you make the payments but you fall below ratios they want you to hold, here comes the bank. And some banks have a strategy called loan to own. It's terrible, it's disgusting, but they do it every day. They make you a loan that they know you're going to fail. The likelihood is very high, propensity that you're going to fail on that loan and going to come in and take the company over, own a company for next to nothing. That's on the debt side. And then on the equity side, typically, if you really need the capital, it's going to come with giving away board seats. Board seats give away control. Even if you have 5 board seats, you give away 2, and there's 1 independent. They can chip away the independent. That gives them 3. You have 2. Now they have control of the majority of the board. Terminate you, get another board seat, 4-1, and boom, they own the company, and you're out. All right. Oh, yeah, of course, you'll have a job title. You'll be the director of marketing ideas, work from home, no direct reports. So you'll still functionally be at the company, but you'll have no control. And so every major decision, if you take debt or equity under stress, every major decision in the future you make about the company will have to be run through people who don't have your vision. This is not the only thing they do, and they're just going to use the average of the average ideas and whatever MBA they got from Harvard, Yale, Tallahassee Community College, wherever, to make decisions for you and your amazing company. And you have to ask for approval. You want to buy a server farm. I've seen deals where anything over $20,000, you have to go to the board and ask for approval. Very tough way to run a company. So the bottom line, Tim Westergren built an incredible company called Pandora. He changed how the world discovers music. But his 2.39% ownership at IPO serves as a powerful reminder to you, to me, to everyone within the sound of my voice. In the capital markets, desperation is the most expensive emotion or situation you can ever have. For middle market companies, the lesson is dead clear. The true cost of capital isn't just the interest rate or the equity percentage you give away. It's the long-term control and wealth that you sacrifice when you fundraise from a position of weakness. The next time you face a capital crunch, remember Pandora, Tim Westergren, standing before his 50 employees, giving the please don't take any pay, stick with me speech, and saying we're going to go out and we're going to find the money. Sometimes the most expensive money is the money you take when you have no other choice. And when I say sometimes, I mean all the time, right? So you want to always have choices and access to the capital markets, and you don't want to start going out for money when you need the money. If you want to discuss strategic capital planning, if you're a middle market company, the decisions you make today about funding will determine whether your deals become the next WeatherTech, the next Airbnb, the next Rogue Fitness, the next OK Stone Engineering, or the next Pandora. So again, you can contact me, click below, get in contact if this is an issue you're facing. We can talk a little bit more about it. If you just want to dive deeper into this and how to plug it into the deep economy and capital markets, then just search my name, Oren, Deep Economy webinar. Check that thing out. We'll find some way to get in touch. Until next time, I'm Oren, and this has been The Game of Money, sponsored by Pitch Anything.